Welcome back, everybody, to another real estate market update for the Milwaukee area for June 2021. We have some really interesting data today to look at and some new trends that are unfolding here in Milwaukee. And I'm going to run through this with you rather quickly because I have a plane to catch. I'm going to spend some time with my family in Europe, and I'm very much looking forward to that. So quickly, let's take a look at the numbers. Where we're with inventory, 3,600 units for sale in May. So still a very extremely low inventory, and we have yet managed to sell about 2,500 homes. So that is 11% more. How is that going? Selling more with less inventory? Well, not very well. Super competitive, as you can imagine. And again, we are seeing prices driven up to $247,000. So millennials are number one home buyers. We're seeing that everywhere. We're typically getting 5 to 10 offers on every listing, so it's very competitive. It's very difficult to get a house under contract. You really need to know what you're doing, and oftentimes it goes up 10% over asking price, and buyers are waiving a lot of contingencies. We're going to talk about that a little bit more in just a second, why this is happening. But I want to give you some context why the numbers are, showing where they are, and you can see basically the same trend here for Milwaukee. But let's jump back here a few years to May of 2015 versus May of 2014. So those are old numbers that I pulled back in here because I wanted you to have a perspective. The reason why I like 2015, because it used to be a neutral market. We had already well recovered from 2008. It was pretty balanced between buyers and sellers. And we had about 13,000 homes for sale in the Milwaukee area. You could already see that the trend was going in this direction because inventory was down 5.6% year over year, and homes sold was up and prices were up. But look at the price difference, 162,900 as opposed to the 247,000. Apologies for the missing zero here. But that is a huge price increase over the last 6 years. And from everything that we can see, we're going to stay in this market, and it's going to be like this for a while. So let's take a look here at some stats. We have a number of listings in Milwaukee, so this is a good trend. We are finally seeing some movement in that gridlock that we had, because a couple months ago I was really worried that we're going to that the market is going to seize up, because we're not getting anybody to sell their house because they don't know where they can move to. I had a lot of clients that are telling me, yeah, we can't sell our house because where would we go? There's nothing on the market that we can buy. Now we are seeing a little bit more momentum going. We have more inventory on the market, even though it's still very, very low. It's increasing. People are noticing that. They're getting more confidence that they can find something they can buy. And so now they're more confident talking to me about listing their home and putting it on the market. So we're entering a little bit of an inventory upward spiral, because the more inventory comes on the market, the better it will make sellers feel about selling their home and not being homeless, if that makes sense. All right. The downside of this, of course, is our sold to list ratio is absolutely through the roof. So we're hitting, according to the local Milwaukee MLS, 104% sale price to list price ratio. So on average, we are paying 4% more than list price. This is for an average. This is completely unheard of. I just mentioned that we're seeing 10% over asking is kind of a normal thing right now. So if somebody lists a home for 200,000 that it sells for 220 or 225, that is pretty much going rate the way it is right now. And you see it here in that ratio. So historically, we always have been here in the 95, 96% range. People used to negotiate. Not anymore. If you've been watching my videos, you already know this, but we have never seen it to this extreme. And like I said, there is really no end in sight from what I can see in the data at the moment. Here's some new data from Fannie Mae. They are measuring what they call the home purchase sentiment index. And that is really great news. You see here a nice V-shaped recovery, almost perfect V-shaped recovery. So what this is expressing is how many people are thinking it's a good time to sell a home. And of course, if a lot of people are thinking it's a bad time to sell a home, then you're not going to see much inventory, and the market is seizing up because you don't have that movement anymore. The market is losing liquidity. and you need a home to stay. You can't sell without buying, so that's a problem. So we're back to 67%. This is pretty much where we were pre-pandemic, and that is better than we were a few months ago and a lot better than we were a year ago. And that means we are going to see more inventory coming on the market. So that is really good news for my buyers because they need a little bit of inventory to shop from. Now here's something that is super interesting, and before we get into this, let me just give you a very quick refresher on demographics. So this is the US population, about 330 million, and we have the youngest guys here. There's Gen Z, they're 0 to 20 years old. Then we have the millennials, 21 to 38 years old. Every time I mention millennials, people are thinking about somebody who is 22 years old. That is almost Gen Z. The oldest millennials are now 39 years old. So they're almost 40. They're getting married, they're having babies, and they're changing their attitude towards housing. They always said, no, we don't ever want to buy a house. We're going to keep renting. That's how we like it. And we're going to Uber. We don't need a driver's license. So once you have getting married and kids on the radar, then of course that changes and they're thinking about houses now. And a lot of them are buying houses. So this is the number one segment, not only in the US workforce, but also the number one segment that we have in Milwaukee buying homes. We have about 160,000 millennials in the Milwaukee area so that makes 80,000 couples if they all get married. So it makes 80,000 home buyers in a market where we have 3,600 homes for sale. So you can see how that is going. Generation X is my generation, 39 to 54, 55 years old. And then we got the baby boomers, which are getting into retirement age now, and then of course silent generation. So with that in mind, let's go take a look what's happening here. So bear with me if this looks confusing, it will make sense in just a second. So what you have here in yellow is the Milwaukee real estate market, and these are the different price segments, and the size of these bars represents roughly the size of these housing markets. So you can see over $750,000 is a very, very small segment in percentage of the Milwaukee market. Even the segment 500 to 750 is a small segment. And then you have the middle segment, the 350 to 500. Those are nice big houses. That's a junk. And then you have the big segment that is 72% of the entire housing market in Milwaukee here, that are houses under $350,000. So this is not what's for sale. That's total inventory houses that exist in the Milwaukee area. So under 350,000, that's our biggest segment. Now, what's happening here, when you look at who is buying what, we have some interesting things that are happening. We already discussed that a lot of young people are moving out of rentals because of a change in lifestyle, in family status. They're having kids, they're getting married. It's just time to stop renting and, quite frankly, wasting money. And they're also thinking financially differently now. Once they have kids, they're thinking about equity and net worth and family wealth. And home ownership is just one of the ways to go there. So this is more and more a trend, and a lot more millennials are pushing into this market, and they're becoming first-time home buyers. And of course, the market under $350,000 is the perfect market, because that's, if you have two incomes, even with some student loans, that is very attainable if both are working. Now, the problem that we have here is that in this market, we don't have a whole lot of sellers. And COVID really blocked the whole thing because nobody wanted to sell. People were worried. So now we're finally seeing sellers, and it is mostly Generation X people, so my generation, that is trading up. So these are now trading up buyers. They're selling either from this segment and they're going up into the 350 to 500 segment, or they're selling here in the 350 to 500 and they're trading up into the 5 to 750 segment. So when they're selling their house, a slot becomes available in here and a millennial can buy it. Or when they're trading up here, a slot becomes available and somebody can move up through that chain here, if that makes sense. Now, the problem is that a lot of people are not thinking about that we also have baby boomers, and a lot of them are thinking about downsizing. So baby boomers are oftentimes living in a very large home that they bought when they had their kids, when they raised their kids. They needed a 3-bedroom, 4-bedroom, or even bigger home. and now the kids are gone off to college or even in their 30s and 40s. So baby boomers are ready to sell their homes, and they're downsizing, oftentimes into a condo, but very often they like being in a single family home. And what are they looking for? They're looking for something without stairs because they don't want to climb stairs anymore. So they're typically looking for a ranch home, and they're typically not looking to take out another mortgage. So they're selling their expensive home and they're buying something that they can buy without taking on an additional loan. So they're competing now on nicer ranch homes, I would say in the upper segment of this, 350 to 450. So they're buying up ranch homes there, and there's a big difference. They are being tough competitors with the millennials because baby boomers have owned a number of houses in their life, sold a number of houses, worked on a number of houses. So they have cash, they have equity, so they're going to be cash buyers, and they're also a lot more comfortable waiving contingencies. So if you have had 5 or 6 or 7 houses in your life, you are going to be a lot more relaxed about a home inspection than a first-time home buyer is. These guys know what they're doing, they've seen it, so they're making cash offers and they're waiving inspections. And this is putting a lot of pressure on the millennials that are also coming into this market, and they're facing that competition from the baby boomers who are coming in with cash. Millennials typically have student loans and not too much money, so they're coming in with financing and they're worried about inspections. So uneven competition here, and you can see we have a lot of buyers, but we don't have a lot of people draining out of this segment and creating vacant spots. So it's just the Gen X's that are trade-up buyers. They're taking advantage of really good sales prices here. So they're selling for a very high price. They're trading up into a bigger home. Usually they're motivated by working from home, working out from home. So having a home gym, having a basement where they can work out, having a room for the kids, having a bigger backyard. This is what's motivating Generation X people to trade up into the bigger spaces. And what they're also doing is they're building new construction. So when you look around on the internet or even when you're driving around here in the Milwaukee area, you will notice there is no new construction, zero in the city. Anywhere in the $350,000 space, no new construction. New construction starts just under $500,000. And most of it is actually in the 600, 650 all the way up to 850, $1 million. It's very easy to spend $1 million today on new construction, even with the lumber prices going up and other material costs going up as well. So $1 million home is not as big as you might think when you build it new. So this is where the new construction is happening. So normally we would have a quite balanced flow here with how the market is working, with vacancies becoming available, and then people are trading up and people are coming in and filling that spot. But what the market cannot handle at the moment is this situation that we have baby boomers and millennials compete for the same market without an increase of supply. That's really the conundrum. At least we're seeing some mobility now with COVID with COVID vaccinations, I should say, and confidence going up. We're seeing more mobility, so houses are coming on the market. We're seeing more inventory, which makes sellers more confident that they can find something. So that is becoming a little bit of an upward spiral, hopefully on the inventory side. And we have a big pool of rentals here. 45% of all units in Milwaukee County are currently tenant occupied. So that might be an apartment building, that might be a single family home, a duplex, but this is where that trend's coming from. All right, what else is going on? Let's take a look at expenses. I spoke in previous month extensively about that. We're all saying homes have gotten so expensive, but at the same time, when you look at the data, you can see that historically, and I invite you to go back on some of the previous market updates. You can see that affordability is still very, very high. Affordability now is still much better. It's much easier to buy a house with an average income than it was, for example, in the early 2000s, 2004, 2005, etc. So we have very good affordability, and you can also see that here in this chart. Here we have how much are people spending from the household income, either for renting or for buying. So people are spending on average about 26% of the household income for renting, or 16% of the household income for home ownership, for buying a home. And that is overall incomes. And That of course gets even worse because the lower you go down in household income, the less discretionary income is available, and the more of that income you need to meet the basic needs with this, which is food and shelter. So more and more goes to that, but the pattern stays the same. Home ownership is going to be cheaper than renting, and that's also part of what is driving the housing market. Another interesting development, and I'm really proud of my fellow Americans here, is talking about fiscal responsibility and saving up a little bit of money. So this is really good news. I was excited when I saw that first last year. Savings rates in the US are up. So this is one thing that COVID and the whole thing did. I'm sure there's some stimulus money in there as well. But that aside, it's generally a good thing that people are saving up money and not just living off their credit cards. So that is generally a good thing. The problem is that at the same time, we are also seeing inflation. And with inflation, savers are losers and borrowers are winners. So what inflation does, it eats up the value of the currency. So you have $1, $1,000. Now the $1,000 that you saved up, next year you can buy less for it than you could this year. So the $1,000 that you're holding, they are losing in value. So that is what inflation does to your savings. And normally the bank is paying you interest rates to keep you to keep you up with inflation. But now at the moment they're not paying interest rates either. So you're really going down, and you're looking at the numbers in your savings account. They stay there, but when you look at what you can buy with that money, that becomes less and less. And on the other hand, the same thing happens when you have fixed interest rate debt. So if you have mortgage debt that is secured fixed interest rate for 30 years, that payment that you pay every month, that is not going to change. But as we are seeing inflation, the value of that payment that you're making every month is smaller and smaller. So inflation really brings both sides down. It brings the value of your savings down, but it also brings the value down of what you owe. So that is the tough side. So inflation is neither good nor bad by nature. It's just what it is. So it depends a little bit on which side of the equation that you are. But if you're sitting on a lot of cash, that's not a good thing. You might want to think about that. We will have to keep an eye on inflation. Consumer price index, if you've missed it, came out a couple of weeks ago at 4.2%. So the Fed has always been talking about 2% inflation. Now we're CPI at 4.2%. When you look at lumber prices and other construction material costs like Romex, wiring, cost of drywall, steel components, garage doors, windows, everything is absolutely shooting up, and a lot more than 4.2%. So we will see what the inflation data is telling us in the future, but that's definitely a thing to keep an eye on. So here's another survey, and this is talking about how many people are planning on buying a home in the next 12 months. And this is basically, from Q1 2020 to the last quarter. And we have seen an increase in the last 12 months of 6% or 6 points, going from 10% to 16%. So that means we are going to have 60%, from 10 to 16, that is a 60% increase. We are going to have 60% more interested buyers in the market in the next 12 months. So, a lot of people are responding to this. They're seeing the same data, and demand is just not going away. It's simply a question of supply and demand. And the more housing becomes a scarcity, the more desirable it becomes. And a lot more people are thinking about buying a home. What's going on with interest rates? Here's the latest update from Freddie Mac, 30-year fixed. So we had a little, this chart is not showing it, but currently we're a little down again. But this is apparently the last dip before rates are supposed to go up. So the Freddie Mae projections are that we are creeping up to 4% by the end of the year. So at the moment you can get a 30-year fixed for right around 3%, and by the end of the year we're expected to be at 3.8. Some forecasts are actually aiming as high as 4%. That is still, if you put it in historical context, still an extremely low interest rate, because if you go back into the 1980s, we had 16, 17, 18% interest rate on a home mortgage. It's like credit card debt. It's crazy. But even when you look at the last 10 years, 5, 6, 6.5% were kind of a normal interest rate for a mortgage. So, is it the end of the world if we go from 3% to 4%? No. I encourage you to do the math, find one of these apps on the internet or on your phone where you can calculate mortgage payments. You will see going from 3 to 3.5%, or from 3 to 4 is not a huge difference, but it is also not insignificant. And when you look at it, how much it costs you every year over 10 years, that is actually a huge amount of money. So, people are realizing that, and that is also driving urgency, and people want to lock in with low interest rates as long as they can. Especially if you're a trade-up buyer, if you're my generation and you're selling something, in the $400,000 range, buying something in the $600,000 range, facing inflation and low interest rates in that particular scenario, that makes actually a lot of sense. All right, moving on here to a survey from Gallup, and I usually don't show that here, but I thought it's interesting to see what has changed here over the last 10 years. So the question from Gallup was to the American population: what do you see as good investments, as good long-term investments? And real estate has reached a level it had never reached before. So people have extremely high confidence in real estate. And when you look back 2011, of course, that was in the wake of the 2008 mortgage crash and subprime lending crisis. So the confidence in real estate was low at the time. And now that prices are much higher, ironically, confidence is much higher as well. But for everything that we can see in the data, there's really no end to this market in sight on the horizon. It looks like we're going to keep going in this direction for quite a while. But real estate has basically swapped positions with gold. So gold used to be the number one long-term investment, and for those of you who are investing in gold and Bitcoin, you can probably relate to that. Real estate has swapped positions here with gold. Gold is not on here. And, savings accounts, we spoke about it earlier, is really not very appealing and not very interesting at the moment. People are going to hard assets. Speaking of hard assets, here's a quick update. I haven't mentioned forbearance in a few months. A year ago, I got hammered on social media. Oh my God, we're going to have, a forbearance crisis. A foreclosure tsunami is coming. We're going to have 2008 all over again. There's tons of YouTube videos about that too, and about the market crash. So we keep heading in the same direction. When you look at the data, I think data is always good because, looking at facts and data takes the emotions out of things, and you just look at numbers and you do math. And this is forbearance. So forbearance is coming down. I think the last time we spoke, we were around 3 million loans in forbearance. Now we're down to 2.3. So a slow and steady decrease. Now we're getting to the bottom of the barrel. So we're not coming down as fast anymore as we used to. So it's getting tougher. But when you look at the breakdown, and I have it here on this slide, you can see that most of the people who have been in forbearance in the last year actually managed to get out of it either quite well, or meaning with no problem, or they have a good plan in place and they're working with the lender and they worked out an agreement so they can stay in the house and make on payments or catch up on payments, whatever it is, do a loan modification and stay there. We have about 14.6, about 15% that are really in trouble, and I expect this percentage to go up maybe to 16, 18, 20%, because we're getting to the bottom of the barrel here, and so we're going to see more of the tougher cases now. So what does that mean? If we have about 20% of them default, so they will actually have to sell their home. They're not going to go into foreclosure, because you go into foreclosure if you don't have equity, if you owe more on the house than it's worth. If you have equity, then you don't go into foreclosure. You just call a real estate agent and you sell it. But that still means we're going to have inventory on the market. It just means that inventory is coming quicker, because foreclosure takes about a year in Wisconsin. So if they just sell it, that goes faster. And we are going to see inventory from that. When you do the math about, and divided up for, break it down by state, 20% comes out to about 9,000 homes that would be eventually affected by that. Now, when you take into consideration that in Wisconsin, the unemployment rate is a lot better than national average, surprisingly, look it up, we're at 3.8%, national average is 6%. So from that point of view, if more people are working, we should see fewer defaults on mortgage payments. We should see fewer homes coming on the market. I think the market can totally handle 10,000 additional homes right now without any problem. We'll find you buyers in a very short amount of time to occupy those homes. So that would be welcome inventory. But I think because of the unemployment rate is rather low here in Wisconsin, we're going to see less than average on a national level. So we may end up with about 5,000 or 6,000 homes that are actually going to be sold out of a forbearance program. So a little bit of inventory will come there, but I'll keep an eye on it. It's not as hot of a topic anymore, but if I see some changes here, I'll definitely going to report on it. So here's my outlook for summer 2021. The market is very deceptive right now. So when you look at market data between now and 12 months ago, remember that was the time when we just went into full lockdown and, stuff hit the fan and, it was really bad with COVID and nobody knew where this was going. So it's not really good to compare the current market with 12 months ago. And I've started seeing that showing up in the evening news, and those numbers are weird. So don't pay too much attention for that, because 2020 was really an anomaly. And so it's hard to compare those numbers. We're going to see slight increases in inventory. Somebody will say, oh my God, inventory is up 30%. Yes, compared to what? We are still, keep in mind, Milwaukee had about 13,000 houses for sale back in 2015. And now we have 3,500 and we're celebrating because we have more inventory. We are still a far cry away from having inventory on a normal level that the market would require. So still very, very low on inventory, but it's going at least in the right direction. The vaccinations help. The whole economic progress is helping. We're moving in the right direction. But we're also seeing a very, very competitive market. 10% over asking price on hot deals is very normal. Not every house sells that much. There's still about 35% of the houses that are selling for less than asking price. So they're either not well marketed or they're just hopelessly overpriced, whatever it is. Well-positioned homes are going, and if they're in good condition, they're going well over asking price. And if you're on the buying side, you need every little bit of competitive advantage that you can get in order to get a house under contract. Otherwise, you'll be writing a lot of offers. Milwaukee will remain hyper competitive this summer. Medium price points will start to appreciate. So most of the appreciation has happened in the $350,000 price range. We're going to see now more of these move-up buyers, and that is bringing that appreciation also into higher price points. So we're seeing that there's still very, very little appreciation in the top price points. So luxury and ultra luxury over $1 million. Sellers are sometimes thinking, oh, our house is worth now 10% more. No, it's not. That 10% appreciation is really for median priced homes. It doesn't really apply, but we are seeing now a little bit of an increase also in these luxury properties. They also start going up in value, just in percentage, not as much as the median priced homes. And I would say keep an eye on inflation. That is going to be an interesting question for the months to come, and see what the Fed is doing and the data that we're seeing here. A lot of people are thinking that once supply chains are catching up, then prices will come back down again. I hope they will, but I have a feeling that they will come down to a certain degree, but not all the way. There will be somewhat of a middle ground, which means higher prices, which means inflation. And then it's just a matter of how long will that stay and how high will it go, and what is the Fed going to do against mitigating the inflation if they're doing anything about it. So that's pretty much all I got for you. Here is just a quick slide with all my data sources if you're wondering where I have all that good stuff from. So those are things that I subscribe to and summarize for you on a monthly basis. If you like that video, I would really appreciate if you give it a thumbs up. and means a lot to me personally for making the effort of putting this together for you. And also comment just below and let me know what you think about this, and I'm going to see you next week.